Hello, everyone, and thank you for joining us this afternoon or evening, depending on which coast you're on. Bob and I here are representing both coasts. Brittany Piquel with Next Generation. If you've attended our webinars before, you've probably heard me. We have a special guest with us tonight, Bob Malecki, and he's managing member of Notable Capital Management. He's going to be talking about a very interesting topic tonight, creating wealth from distressed debt. Not only doing that, but using a self-directed IRA to do so and to build retirement wealth in a tax-advantaged way. And then I'm going to do a little bit of just a crash course on self-directed IRAs, just for anyone on the line who may not be familiar. Just a couple housekeeping items. The webinar is being recorded for anyone who was unable to attend live tonight. So if you did register and you provided your information, you will receive a copy of the recording. Also, if you have any questions throughout the duration of the webinar, feel free to enter them into the question box. And once we're finished with the main section here, we're going to read through those and we'll field those as best we can for you. So without further ado, Bob, I will let you get it started.
Thanks, Brittany. Hello, and everybody. And again, thanks for taking your evening or afternoon to attend this webinar. As Brittany mentioned, I'm Bob Malecki. I am managing member of Notable Capital Management. We're a private equity firm based out of Austin, Texas. I actually live in Seattle. I work with Josh Andrews and Scott Ruzich, my partners, to raise capital and deploy that into non-performing or distressed mortgage debt. And again, as Brittany mentioned, please post your questions in the chat or comment section of the webinar tool, and we'll get to those at the end. I'd be happy to answer any questions. Let's see here. Okay, good. So just a little bit of housekeeping. Just want to make sure you know that this presentation is not an advertisement to sell securities or a solicitation for any purpose. So please contact your own tax advisor for any questions specific to your situation. This is an educational presentation only. So I've been investing in residential real estate since 2007, and I opened a self-directed Roth account for my wife and myself in 2009. We wanted to do this to create tax-free profits from real estate investments. And around 2010 or so, we created a multi-member LLC, which the members were basically both my wife and my Roth accounts and one of our family members' self-directed IRAs as well. And we purchased rental properties in Memphis, Tennessee and San Antonio, Texas. And since then, we've actually liquidated all of our rentals, and we took that cash and bought notes, non-performing distressed debt, and we did carry back 2 notes on 2 of the properties to investors, and we still have those in our IRA portfolio as well. In this discussion, I'm just basically going to talk to you about how notes work, what the advantages are of notes, and how to purchase them in your self-directed IRA. And just to give you a bit of info on Notable Capital, again, as I mentioned earlier, we're a privately held equity fund. We provide passive investment opportunities to those looking to take advantage of the disruption in the residential mortgage market. We purchase distressed debt from financial institutions at a deep discount and then restructure the loans with our borrowers so they can afford to remain in their home and resume their loan payments. The result is a win-win for everyone. Families stay in their homes, communities are stabilized, and our investors earn a safe and consistent profits from the loan payments secured by that real estate. So I've owned quite a few rentals and always had this fantasy that all of my tenants would basically leave me alone and just send me money. Well, I finally realized that those are called borrowers. And once I created a system to buy mortgage notes, I then liquidated, as I mentioned before, our rental portfolio and purchased notes to essentially become the bank. What I found is that owning the debt lets me buy assets at a fraction of the home's value while generating monthly cash flow. And I can do this with none of the hassles associated with being a landlord. Covering basically what is a mortgage note? And in the context of this presentation, essentially a note is a promise to pay, typically collateralized by the property. The collateralization is completed either through a deed of trust or a mortgage, depending on which state the property is located. In general, states east of the Mississippi are mostly mortgage states, and those west are trust deed states. Notes usually start out as performing, but can become distressed due to non-performance by the borrower. And those notes can be sold to another party via what's called an assignment of mortgage, an AOM. This is where the current holder of the mortgage, like a bank, would assign all rights to the note, including collection of interest and principal, to the buyer of the note. The assignment is then recorded in the property's local county records. And this is how we purchase notes, both distressed and performing, via the assignment process. So we buy non-performing notes at steep discounts and restructure the debt with the borrower. And this essentially allows us a high profit margin when the borrower resumes performance on their debt. Notes really aren't that sexy and require a lot of upfront due diligence, but we found in the long run they provide a much better cash flow and are less problematic than owning rentals or flipping homes. So in this presentation, again, I'm going to discuss why distressed notes are a better asset class than owning real property and how you can buy notes in your self-directed IRA. Now let's take a look at how we can become the bank. Essentially, when a person buys a home, they borrow the funds from a bank. They then sign a promissory note as their promise to pay the bank loan, and a mortgage is created, which then that mortgage places the property as collateral for the loan. This provides a recourse for the bank in case the borrower defaults on their promise to pay. The borrower then begins making monthly payments to the bank. Now, eventually, if the borrower stops making payments, defaults on their loan, the bank can foreclose. They can modify the loan to get the loan reperforming, or they can sell the loan off. And depending on the asset that's backing the loan, the bank may do nothing other than extend and pretend and eventually sell that off in a pool to a note investor such as my company. What we do is purchase the non-performing note from the bank and essentially become the bank. Because we can buy the note at a substantial discount to value, we can modify the loan terms to allow the borrower to resume performance, thereby creating a cash flow stream. So for us, it makes more sense to become the bank rather than the borrower. Excuse me. By owning the debt rather than the property, we have more control over the asset with less complications that come with home ownership. Also, because we can acquire the distressed debt at a steep discount, we realize a higher return on our investment and safer capital preservation, since our capital outlay is typically 50 to 60% of the home value. Now let's look at the market dynamics that created this opportunity to buy distressed mortgage debt. If you read the book or saw the movie The Big Short, it provides a good perspective on what occurred to create our housing bubble and subsequent collapse. Essentially, a small group of Wall Street investors saw that the resetting of stated income loans from teaser to full rate will cause massive defaults and crash the housing market. Unfortunately, they were correct. So there's been an opportunity to acquire distressed mortgage debt from financial institutions as a result of this event. This is a portfolio of what we call seriously delinquent loans, those over 90 days unpaid that are held by financial institutions. After the meltdown, the federal government approved a $700 billion bailout to the banks and put in safeguards to keep this from happening again. The Dodd-Frank Act, introduced in 2010, has provisions that pressure financial institutions to offload their distressed debt to the secondary market, typically by selling them to hedge funds. And these loans are sold in prepackaged pools, and the hedge funds are forced to buy pools of mixed assets, some assets they want, some they don't want. Inevitably, those are some assets they don't want, and they will sell them downstream to smaller investment companies such as my company. Oops, let me go back up here. So notes can be acquired in various stages of risk. A performing note that has 12 months or more of payment seasoning is typically the lowest risk, but usually it's going to have a lower yield, probably around 8 to 12%. When you move down the performance spectrum, the yield will increase. This is because the non-performing assets can be purchased at a lower investment to value ratio and produce a much higher return on investment when we get the note restructured and the borrower resumes performance. The last resort is either foreclosure or deed in lieu. And this is where we take the property back. We all know, I think, what a foreclosure is. A deed in lieu is basically a transfer of the ownership of the house, the underlying asset, to our company or to myself and my self-directed IRA, usually via a quitclaim deed. And so the borrower can basically walk away from the home, transfer the deed to us, and then we can liquidate the property, regain our investment capital as well as our profit. Because we own the debt rather than the property, there's a lower risk since we don't have to deal with the contractors, vacancies, vandalism, and evictions that you might find in owning rental property. The acquisition and management of the debt is more scalable since we're able to collect monthly payments without any immediate responsibility for the maintenance of the underlying asset, the home itself. That's up to the homeowner. That's up to our borrower to take care of their property. And I've yet to have a borrower contact me if they need their toilet fixed. Now, some folks who have a deep understanding on how to trade stocks and make a killing on Wall Street, but most of us are at the mercy of the market. By owning mortgage debt, you don't have to deal with the swings of the stock market, which are dictated by both domestic and international events. You can earn higher margin if you buy the note correctly, and the note is secured by the underlying asset, the home, which can be liquidated at a minimum to recover your initial capital and provide some substantial profit. And lastly, you have more control with notes since you're the bank and determine what level of profit you want based on your desired exit strategy. So I'm going to do a little analysis here about owning the property as a landlord versus owning the note on that same property. And understand my math is kind of generalized. This example is just to kind of drive home a point. So if we purchase the note on the house before it goes to foreclosure, we're able to acquire the note at a much steeper discount than we would at the REO as an REO asset or at the auction. On the left side, we have the typical landlord. Let's say this is a $60,000 house. You put down 20% or $12,000, and you can rent the house for $550 a month. After we subtract out principal and interest payments on the loan, maybe $30 a month for maintenance, $60 for taxes, and $35 for insurance, there's a net profit of essentially $132 a month. If you annualize that based on the $12,000 down, that's about a 13.2% profit. Now, on the right side, if we buy the note, let's say for $20,000 cash, I'm sorry, that should say $40,000 cash. It should be $40,000 cash. We're going to be collecting about $660 a month of principal and interest on a $60,000 note. I think that's factored out at an 8% rate. We pay a $15 a month service fee, which is $4,140 annual, and that provides us a 19% annualized return on our investment. Plus, again, we don't have any maintenance, no taxes, no insurance, no tenants, trash, or toilets. And if the borrower should default, we can foreclose and gain our equity back from the house as well as our original capital account. I'm going to show you an example now of a note that I bought in our self-directed IRA LLC. Gosh, I think this was back in probably about 6 or 7 years ago. We still own this note. This is a 2-bedroom house in Charlotte, North Carolina. The unpaid principal balance, or UPB, when we bought the note was $50,231. The borrower had signed a loan agreement for a 30-year term at 11.15%, and it was originated in 2001. So he had monthly payments of $524 a month. He stopped paying on this loan in 2009, and he gathered up, or the lender gathered up about $25,000 in arrears. And arrears are essentially unpaid interest, penalties, as well as taxes and insurance payments made by the lender on behalf of the borrower if he didn't make it. So right now, this guy's sitting on not paying his loan since 2009, has $25,000 in arrears. He was recently reemployed and completed a hardship letter and wanted to do a loan modification. We also, when we bought the note, the previous lender had already started foreclosure on the property, so that basically put the borrower on notice that he's going to lose his home unless he does something, and that hence is why he completed the hardship letter to try to get a loan modification. So we bought the note in 2014 for $14,300, including a broker fee. So what we did was we agreed to modify the loan to a 7% annual rate for him and re-extend the term to a new 360-month or 30-year period. Now, the borrower had some cash available, and we negotiated that he pay us $10,000 down towards the arrears, and we forgave the remaining $15,000. In hindsight, I probably would have tacked that $15,000 onto his loan and amortized it over a higher balance, but it worked out anyway. Essentially, we brought his payments down to $338 a month, which he can afford. And that, based on our net investment of $4,300, remember we paid $14,300, we got $10,000 down, so now our investment is $4,300. That provides us the annual yield of 84% on our money. If we had to foreclose on the property, the ROI will basically, on the next slide I'll show you, the value of the property has gone up. But even at the time, if we would have had to foreclose, we would have gained our capital back and had quite a good capital infusion because we could have foreclosed for maybe $25,000 value on the house. And all of the difference between our $4,300 investment and whatever we got at the foreclosure auction in cash would be our profit. So multiple exits. So the property, the UPB right now, today or in this week, the unpaid balance is $49,147. And I got on Zillow and looked up the property, and actually the value of the property has gone up to like $90,000 because Charlotte's just a really good market. So if we were to foreclose today, we could foreclose for somewhere between $80,000 and $90,000 at the auction and recover 100% of the unpaid principal balance of about $49,000. Another option would be for the borrower to refinance. He could refinance and pay off our loan. We could sell the loan to another investor for maybe 80 to 90% of the balance, or we could sell a partial amount of payments to another investor. Let's say 10 years of payments, we could sell off for a certain amount of money and capture some of our capital and then get the payments back later. And I'll talk about partials in a slide in the future here. Or we could foreclose and capture the equity. So let's talk a little bit about note investing with your self-directed IRA. And I've been doing this essentially since about 2011, and I've really enjoyed it quite a bit. So there's three ways to invest in residential notes with your IRA. As I outlined previously, you can buy a non-performing note, do the workout with the borrower, and enjoy the cash flow. This is going to provide you the highest yield, but it also requires a really thorough knowledge of note investing, including due diligence, market analysis, negotiations, and evaluating multiple outcomes. You can also buy a note that's already performing just for the cash flow, or buy that partial, where you buy a specific period of payments for an agreed price. The latter two options is going to give you less yield, but also requires less specialized knowledge. You can also partner in a joint venture with another investor on a non-performing note. Typically, your IRA will fund the purchase of the note, as well as the estimated expenses for servicing, foreclosure, and any due diligence and title expenses. Then you and the note investor will split the cash flow as well as the capital gain should you exit through foreclosure or payoff from the borrower. This is a great way to earn a higher return on your money without having the specialized knowledge needed for a profitable outcome. And lastly, there's a pooled fund. You can basically pool your money into a private equity fund with other IRA investors. In this environment, the fund manager does the heavy lifting with getting the loans reperforming to provide you a substantial yield. And your investment dollars are essentially diversified across multiple assets in the fund. So rather than buying one note with your money, you can put your money into a pooled fund, and that money is then spread across multiple assets. So if one note goes bad out of 10, or 10 notes go bad out of 100, you've got the other 90 notes there providing cash flow until the fund manager is able to remediate those 10 loans. I think that's it for that. Okay, so some exit strategies. Although you may want to hold cash flowing notes through the full remaining term of the payment cycles, you may want to liquidate the note to recapitalize your account and purchase another asset, even another performing note, which you can reposition for new cash flow. If the note's performing with at least 6 months of consistent payments, which is called seasoning, you can either sell the entire note at face value or at a slight discount to increase the annual yield. You can also sell just a portion of the remaining term known as a partial. And this is essentially a receivables contract where the buyer is purchasing a fixed schedule of payments for an agreed price from you. So you basically can sell off perhaps the next 10 years or the next 10 years of payments, the next 120 months of principal and interest payments to another investor for a fixed amount. And then at the end of that 10 years, you basically pick up the back end of the payments, what's known as the tail. So if the loan was a 240-month remaining term, you would sell off 120 or 120 months of payments to an investor, and then you would pick up the remaining 120 months after the investor gets his 120th payment. So for non-performing notes, your exit will require more effort and a deeper knowledge of the intricacies of distressed debt. Since you're the lender, you have the same rights and protections set forth in the note and the mortgage agreement signed by the borrower. Although my last resort exit is foreclosure, I'd like to keep people in houses. There can be a substantial profit realized if that loan was purchased at a good discount, and I factored in my holding costs and legal expenses. You can also take a deed in lieu, as I mentioned, and sell the home. We've, in our fund and in the previous fund that I run, typically a deed in lieu can be problematic if there's a lot of subordinate debt with the loan. So if the borrower wants to sign the house over to us via a deed in lieu, that's great. But if they have $30,000 of medical bills on a lien on their property through that, or some credit liens, unfortunately, when we take a deed in lieu, we also inherit the liens that are on the property, and we would have to pay those off. So if there's no substantial subordinate liens on the property under our loan, under our first position loan, then we would probably take a deed in lieu, which will save the borrower having a foreclosure on their credit record, as well as save us money in legal fees and time to go to auction and so forth. So now I'm going to turn over the presentation to Brittany, who will provide you with some information on getting your self-directed IRA set up and the basics of self-directed IRAs. And like I said before, afterwards we'll have some time for questions and answers.
Thanks, Bob. Yeah, that was great. So by now, I think everybody has a solid understanding of notes and some of the benefits of purchasing notes. Now, I'm just going to talk a little bit about conceptually what self-directed IRAs are and how these are different from using your personal funds to do these types of investments for anybody who might not be familiar. So as I mentioned before, I'm Brittany Piquel. I'm the Director of Marketing and Sales at Next Generation. We're located in Roseland, New Jersey. I've been with the company for about 2 years. Prior to that, I held a position in healthcare finance for several years. We do, as you can imagine, deal with a lot of real estate investors. So I actually have my own investment property as well here in New Jersey by the shore. So I'm always interested in learning about, different types of investments as well. But I'm going to talk to you about the role that Next Generation plays in all of this. So I like self-directed IRAs. We as a company, we're not a bank, we're not a brokerage house. We're a third party, we're a custodian and administrator for self-directed IRAs. So our primary role is to hold retirement plans as a financial institution that's regulated, to provide record keeping on those plans, reporting necessary for tax purposes, and to also provide lots of education around the regulations surrounding utilizing self-directed IRAs. So while we are not fiduciaries, we're not advisors, and we don't review investments for legality per se or legitimacy, because those decisions in a self-directed world are on the investor. We do look at things from a compliance with IRS guidelines standpoint and whether those assets are feasible to hold. So we do a thorough review of any investments prior to processing them on behalf of the IRA account. So just a quick background. We have been in business since 2004. Our CEO is also a real estate investor. She founded the company because she wanted to make real estate investments within her IRA, but she couldn't find a professional to help her make those transactions. So she started as part of a national network of other administrators of self-directed plans, and then she broke off and decided to start her own independent firm. In 2017, we became a trust company, which just basically gives us the ability to custody these plans and assets in-house rather than relying on an outside custodian, which some self-directed IRA companies have to do. So we essentially have everything under the next generation umbrella here. So as I just mentioned, in order to do any sort of investment with a self-directed IRA or retirement plan, you have to have two components, whether they're under the same company umbrella or not. One is a custodian. You have to have a custodian to hold title to the assets within the plan, and that should be a regulated institution. And then you have to have an administrator, which is going to provide your customer service and account management. So if you're calling with questions about your account, you're speaking to someone that's representing the administrator, and then actually processing transactions. So if you're purchasing a note, the administrator is going to take the funds within your self-directed IRA and send those to the entity that you're directing them to send for that investment. So as you can see, the services component, the services arm is located in New Jersey, where I am, and then the trust company actually has a physical location in South Dakota where we're chartered. Essentially, we can hold IRAs in any state that you live, any country that you live, as long as you have U.S. earned income and a tax ID, you can have an IRA. So what actually is a self-directed IRA, and what makes it different from other types of IRAs that we've commonly heard of? Essentially, the only difference is how you make your investments and what you're allowed to invest in. So typically restricted with IRAs that most people have to stocks, bonds, mutual funds, other publicly traded assets. With the self-directed IRA, your world opens up beyond that, and you're allowed to hold what's commonly referred to as alternative assets, non-publicly traded. And of course, real estate assets are a huge component of that, but there are others as well that I'll talk about in a moment. And this has been around for a long time, but it's kind of like a best kept secret because these brokerage firms have lots of marketing dollars to advertise their services, and this isn't a vertical that they're very interested in getting into. So you'll find that most of the self-directed IRA companies are very specialized in publicly traded assets. And obviously, the advantages of doing this are, Bob, you actually hit on it earlier, is less volatility. So we all know that the stock market has been especially volatile lately, and in the last quarter of last year was a little rough. And by investing in alternatives, you're able to hedge against some of that and further diversify your portfolio outside of the stock market, so you're not subjecting these investments to quite that same volatility. And then again, the tax benefits by earning tax-deferred or tax-free investment income, depending on what type of account you're using. We'll talk about those in a second as well. And then the tax advantage, of course, right? So, the control over your investment. So that was something else that Bob mentioned. When you're invested in the stock market, you're really kind of just at the mercy of decisions being made by high-level executives, or how the public is going to react to something they saw on Twitter. You never really know what's going to affect your, the value of your investment. Here you have a little bit more control because you have a say in, number one, what am I going to invest in? What do I want to buy? You're able to do your own due diligence to determine how successful you think it's going to be. And then also throughout the course of that investment, you're making decisions to determine the outcome. And there's $20 trillion tied up in retirement savings, and only about 3 to 4% is used for alternative investments. So this is just really an area that's still, I think, a lot of untapped potential. So some of the types of plans that you can use for self-directed investments, these are all self-directed plans. The traditional, most common for tax-deferred investing, funds when you withdraw them later on are taxable. The Roth, which Bob said that he used, those funds are taxable when they're put into the Roth in that year. So basically, Roth dollars are after-tax dollars, and the beauty of that is they grow tax-free. So essentially, if you've had a Roth for at least 5 years and you're taking a qualified distribution after a certain age, you're taking that money tax-free, regardless of how much you've grown the value. So obviously, there's a trade-off between traditional and Roth, but it's good to know to understand the difference. SEP IRAs, simple IRAs, and then other employer qualified plans are for business owners. And those typically work similarly, but allow for different types of contributions, which we'll talk about in a moment. And then less common are the Coverdell Education Savings Account, which can actually be used to save for a child's education, and health savings accounts, obviously for medical expenses. And there are a lot of benefits there. A lot of people don't know that you can use funds in those to do self-directed investments as well. So ways to get funds into a self-directed IRA once you've established one, you can make a personal contribution. So basically deposit your personal funds into an account. Those contribution limits are dictated by the IRS. And you can also transfer from a like account. So if you've already got an IRA with Fidelity, for example, or Schwab, you can actually liquidate some of the publicly traded assets you're holding, and you can transfer cash to your self-directed IRA and then use that cash to make your alternative investments. If you don't have an IRA, let's say you have an old employer plan like a 401k, a 457 or 403b, you can, if it's no longer active, you can roll those over into an IRA, and that allows you to basically move them from a non-IRA account to an IRA account without creating a taxable event if you're moving it into a tax-deferred account as well. And then a conversion is basically just moving funds from a tax-deferred into a Roth. Obviously, that's a taxable event, but once the funds are in the Roth, they grow tax-free. So there were some questions when people registered about what types of things can I invest in. Obviously, you know real estate is one, and notes is a piece of that. You can buy property directly to fix and flip or buy and hold. Tax lien certificates as well. Private placements, which would essentially be investing, taking some ownership of any privately held company or fund. So an example would be the pooled fund that Bob alluded to. If you didn't want to directly buy a note with your IRA, you could essentially invest into the fund, and you could do that as more of a passive approach. Limited partnerships, we talked about that as well. Hedge funds and any private stock. Precious metals, JVs, secured and unsecured loans you can make or take with your IRA. And then there are some other things as well here. Cryptocurrencies, they were huge last year. Not so much right now the way things are going, but as you can see, there are a lot of possibilities. The IRS is more focused on, in the code, what you can't hold than what you can. So the only two things that they say you can't hold are life insurance and collectibles. And then some examples of that below. So ways you can invest using an IRA. I kind of talked about this just earlier. You can directly purchase a property or an asset in the name of your IRA. So essentially the property that you might purchase would be deeded to your IRA, for example, or a note would be in the name of your IRA. It's not going to be in your personal name because, of course, you want to be using this tax advantage account so that all your earnings are also tax advantaged. You can also partner with others, which it sounds like, Bob, you did in the case of your IRA LLC with a couple other individuals, and then pool those funds together to utilize an LLC to do so. And then, of course, tonight we're talking about notes. And then other types of private placements. We see people invest into startups. or any funds that hold private stock. Spotify before they went public. Pinterest is another one that's been popular lately. So there are a lot of possibilities. Just remember that all investment returns go back into the IRA in order for them to remain tax sheltered. So here's the not so pretty part. As anyone who has a self-directed IRA will tell you, it's very important to understand what the IRS deems prohibited transactions. These basically are improper transactions that take place between a self-directed IRA and what they deem a disqualified person. So I'm actually going to skip ahead and talk about that real quick. So disqualified persons, they define as all these individuals or entities. The IRA holder, which would be you yourself personally, spouse, spouse, ascendants, descendants, and their spouses. So basically, linear. Fiduciaries of the account, which might be an advisor, for example. Entities majority owned by any of the above, which could be an LLC that you might already own or that your family owns. And then people providing service to the account, like a tax advisor or an attorney or a custodian, like Next Generation, for example. So if you're thinking about purchasing something from these individuals or their IRAs, that unfortunately would not be an option. Now, we talked about partnering, which is different. If you're partnering your funds into a newly formed entity, that's okay. But if they're disqualified persons, you have to make sure that those ownership allocations remain consistent throughout the duration of that project, so that essentially you're not doing something that would buy out the other disqualified person's ownership or shares of something. So it really relates to a direct transaction. So going back again real quick to this, 3 types of prohibited transactions per se is basically a direct transaction. So buying from, selling to, lending to, selling from, exchanging ownership of anything with a disqualified person using your IRA is prohibited. Extending credit, which doesn't really apply to our conversation today, but if basically you were taking a loan with your IRA and then you personally guaranteed that, or anyone as a disqualified person tried to guarantee that loan, that is not allowed per the IRS. And then the last one, which is considered self-dealing, is more of a gray area. But essentially, if any IRA owner or other disqualified person benefits from the IRA's investment, that would be an issue. An example of that might be your IRA invests as a minority owner into a fund or a privately held company, but you personally take some compensation for services that are provided. That's not something you'd be able to do because essentially you're double benefiting, and the IRA's investment is allowing you to personally benefit yourself. So this is really, at the end of the day, as with any retirement account, still a long-term play. But it can really be a great way to build long-term wealth outside of just stocks and bonds. So I'm trying to keep this short for today because we wanted to gloss over the basics, and we're happy to answer questions, and we'll check them out in a moment. But there were a lot of questions about how do I even do this, just logistically, if I wanted to get started with the self-directed IRA. So essentially the steps are, you would open an account by completing an application to establish a new IRA. Once you submit that paperwork, everything can be done electronically, it takes about 1 to 2 business days to get the account set up. The second piece is funding the account, and we talked about those options: contribution, transfer, rollover, or conversion, depending on your situation. And depending on how long the other custodian that's currently holding your funds takes to release those over to us, that process really ranges. We've seen it take as little as 2 to 3 days or several weeks. But essentially, knowing the requirements is the best way to go, and we help facilitate that process. And then making an actual investment just requires you to obviously do your due diligence on your investment, agree on the terms with any other parties involved, and then you're going to complete some paperwork that is going to, as the term suggests, you're going to direct us, the custodian, to perform process a certain transaction on behalf of your account. So you're going to tell us you want to purchase XYZ note for X thousand dollars from whoever. So all that information you're going to provide us, and we're going to ask for supporting documentation, which would be, a copy of the note, for example, anything else related to that. And then we're going to do an internal review from a compliance standpoint to make sure that we don't see any red flags, that the investor on the paperwork is named appropriately as your IRA and not your personal name. We do not see any risk of a prohibited transaction involved, and it's feasible for us to hold, and then we go ahead and process that. So I'm going to turn it back over to Bob real quick. I know, Bob, from your experience, it's always interesting hearing, obviously, directly from someone who has the experience using the IRA. So some of the advantages that you've come across.
Yeah, thanks, Brittany. And one important thing to understand is Next Generation it has their own custodial services, and that's pretty important. When you have a self-directed custodian that can make the decisions all internally, there's also other companies that are just administrators, but they have to work with a third-party custodian, and so the approval processes can get more and more convoluted. So I've always recommended to my investors or anybody that I work with that they look for a company that is a custodian that has the custodial services in-house, so that a review of assets and investments can be quicker and decisions made quicker, as well as if there's any reasons why the custodian feels it's not correct, you can get some good feedback from them directly rather than going through a convoluted third-party custodian. And also regarding diversification of assets, 90% of what I do is in notes, but I also own some gold in my self-directed IRA. I own some Bitcoin. I'm hanging on, waiting for that to come up. And last year I invested in some Canadian cannabis stocks that are actually doing well right now. So, there's a lot you can do, oil and gas, and there's all kinds of diversification schemes you can do. And I find notes just one of the areas that I enjoy the best. And just to, kind of summarize the advantages of owning a note in your IRA versus real estate, it basically reduces your operational overhead and risk, and those are much lower. And because the borrower is responsible for the maintenance of the property as the homeowners, they take care of the property, hopefully, and they don't create the typical vacancies and evictions you might find when you're owning property as a landlord especially in your IRA. Buying a note is a simple assignment process. When you buy or sell a home, you're going to deal with an agent, repairs, inspections, financing contingencies from the buyers, and of course tax matters. And with a note, after due diligence, it's mostly just executing a mortgage loan purchase agreement, wiring the funds, and having an assignment recorded. So there's less moving parts to owning a note, and they're, to me, more simpler and more direct than buying and selling a home. Brittany, can you go to the there we go. Go to the next slide, please.
Sure. I think you should have control to advance.
Yeah,
there we go.
There I am. Okay. And so, I really hope I've been able to provide you a good background on why owning mortgage notes is one of the best investments in your IRA. And I'd like to offer you a copy of my partner Josh Andrews' excellent book called Paper Profits: How to Buy and Profit from Notes. If you want to, visit the link here on the slide and register your name and email on our website. And once you're registered, Josh will send you his book and also give you the opportunity for a free consultation should you elect to schedule one to talk about our fund or just generally talk about notes. Josh has got just as much experience as I do. He's a wonderful partner, and we'd be happy to talk to you more about what we do and how you can participate with us. So once again, thanks for attending, and now I'll turn it back over to Brittany for final questions and answers.
Sounds good. All right. So just a note as well, if you have questions or want to learn more about self-directed IRAs, there are a lot of ways to get in touch with us. You can visit our website. You can email us at newaccounts@nextgenerationtrust.com. Our phone numbers are here as well. We're on all social media. You can Google us. And I'm happy to set up a one-on-one conversation to learn more about kind of what your situation might be, what funds you have available, what you're looking to do, and talk about getting something in order for you. So we are going to take a look at the questions submitted here. Okay, we have a couple. Let's see. How do you find the right market? You mentioned Charlottesville, which has the strong housing market. I guess that's for you, Bob.
Yeah. Well, finding markets, that's mainly doing basic research on the internet, subscribing to real estate reports, listening to podcasts. I listen to probably 8 different podcasts. I subscribe to 8 different podcasts, and I listen to those when I'm out walking with my wife and my dog or driving to a meeting. And just getting on newsletter reports for real estate and learning what's going on with the markets. So, you kind of learn to absorb the information and make your decisions. But essentially, I look for markets where there's a good employment base. There's the companies are there that are either, that have employment opportunities, whether it's manufacturing or office, like Charlotte, North Carolina, Bank of America is headquartered there. There's other towns in North Carolina where there's auto manufacturing plants. Oklahoma City's got oil and gas. And so, if you think, well, if the price of oil is going to go down, if you hear inklings of that, maybe Oklahoma is not that great of a market for now, but I've always found it to be good. So essentially, I just look for demographics, employment standards, and also I don't buy any notes. Usually, I don't buy any notes in a community that has less than 20,000 population. And the reason that is should we have to foreclose on the property and put the property on the market, we want to have a substantial audience of potential buyers there. And so smaller towns the property would not move as fast for obvious reasons. And also we don't like to go too far out into the rural areas, even if there's a really neat home and we can get it for a great value. Again, I always look at the foreclosure as my last exit. And I think, if I have to foreclose and take ownership of this property, do I want to own it in this community? And that's kind of how I determine my markets.
Makes sense. A follow-up question or an additional question from the same asker. Are there bidding wars for the notes?
Yes. Well, it's not really bidding wars, but typically we buy our notes from asset managers with larger hedge funds usually. So they're buying a pool of notes and they're selling off what they don't want. They'll put them out for sale, usually through a trade desk. And the trade desk manager will blast out an email to his mailing list saying, here's the notes we have for sale, make an offer. So I'll do my due diligence, pick the notes I want to buy, make my best offer. But at the end of the day, if there's another offer that's higher than mine, usually that's going to go to that buyer. So it's not really bidding. We don't go back and forth. It's basically give us your highest and best. And if you're the highest and the best, then we'll sell you the note. And right now, what I found is there was a large interest in non-performing notes over the past few years, driven through the RIA groups, the real estate investment groups in the cities, as well as with the price of homes going up in most communities, and there's less foreclosures at the auctions. The ability to buy a value-added property through REO purchases or at the auction has been shrinking. So that's driven a lot of real estate investors over to notes with the thinking they can buy the note at 60 cents on the dollar for closing the property. Now they have a really a nice investment at a low price in a rental that they wanted to buy. So it's created some kind of strange competition that I'm competing with people who their exit is foreclosure and resale, or foreclosure and rental. My exit is to get the loan modified for cash flow. So we have different, those two different exits create different price points on the note, and I usually lose.
Okay. Next question. Okay, that asker says thank you, Bob.
Sure.
What does the next generation fee structure look like? What are expenses for the services? Great question. So essentially there's a one-time $50 setup fee to open an account. We're currently running a promotion for February and are offering a $50 credit on accounts opened with a promo code. So that offsets the setup fee. The main fee is going to be the administrative fee, asset administration fee. And we offer two options that you can choose depending on which situation is more cost effective for you. So the first option is you can pay a flat fee per year based on the number of assets held in your account. The second option is a percentage of the account value, the total account value of the IRA or self-directed retirement plan. The flat fee under option one is $325 per year, and the percentages for option two range from 0.5% to 1.5%, depending on the value. So I'd be happy to, depending on what numbers you're working with and how many investments you think you're going to make in your first year, kind of crunch the numbers to figure out which is more cost effective. You, in the first year, would select what option you want to go with, and then you could elect to change that in the future if you decide to take on more investments to a point where maybe option two makes more sense, or vice versa. That can be changed in the future. And then when you make your investment, there's a $100 transaction fee that applies, and that covers that compliance review that I mentioned. There are other smaller fees that may or may not apply to your situation. So if you'd like to get a copy of the fee schedule, I'd be happy to send that over. If you could just shoot me a note to let me know if you do want it, I will make sure that I send it out. And of course, you'll be getting an email from us following up on this. So if you do have additional questions, you can shoot us an email as well. We'll make sure that we address any of your needs. The next question is, can my spouse and I purchase a note together from our self-directed IRA account? We may not have enough within a single account, but together we could. So the short answer is yes, you can. So as Bob mentioned, Bob, I think you said that you did partner with your wife, correct? And another individual into an LLC.
Yeah, we created an LLC with my wife's Roth, my Roth, and family members' Roth as three partners, and then we were able to consolidate those funds. And even more ideally, when we were buying our rentals, because these rentals in Memphis were below $50,000 purchase price, even getting a non-recourse loan at that low value was really difficult. So we had another family member who had his IRA, and he basically loaned our IRA, our LLC, the money, and we put down 30% from our LLC. He put in 70%. We paid him 7% interest every month in P&I payments. So all these IRAs combined together were able to make money on a single family house in Memphis, either tax-free or tax-deferred. As they say in the movies, it was a beautiful thing.
Yeah, so definitely, it's definitely an option to partner with, and maybe the reason you're asking this is because we mentioned that spouses are considered disqualified people. It's okay to partner with your spouse or with a disqualified person. The key is that, for simplicity's sake, let's say you decided to also set up an LLC and you partnered into that venture 50-50 into the LLC. So half your funds from your IRA and half from your spouse's IRA. That means that anything associated with that LLC, any expenses or income, once those funds are distributed out of the LLC and go back to the IRAs, they have to be split 50-50. So whatever you funded originally using your IRA, you're getting back. You're not buying out the other partner's shares or anything like that. As long as you understand that, it can definitely be done. It's common. It's done a lot. And the feature of using the LLC as an entity is that, behind the scenes, the LLC has two members, you and your spouse. However, when the operating agreement is drafted, you can list yourselves as managers of the LLC, which gives you access to that business's checking account. Essentially, that holds your IRA funds, but you actually personally have access to take those funds and invest them into the things that you're looking to do, just always remembering that those are still IRA funds and you need to be within IRS guidelines and rules with whatever you decide to do with them. So as long as you understand.
If I could kick in there for a second, one thing to do is to just, if you're going to do that, find an attorney who understands self-directed IRA and IRAs and the regulations, because it's really important that you stay compliant, especially if you manage that LLC yourself. and don't get an LLC operating agreement off LegalZoom or something online. Those are not worded correctly. There are specific language in the LLC operating agreement for IRAs that have to be there, and if it's not there and you get audited, you're going to see some penalties and possibly you have to shut down your whole self-directed account. So that's my word of wisdom for that.
Yeah, good point. We actually require that anyone setting up an IRA LLC use an ERISA attorney to do so. And those are the attorneys that are going to understand the laws surrounding this. If you're not familiar with any ERISA attorneys, we don't necessarily recommend specific attorneys, but we do have on our website a list of attorneys our clients have used and that they use often for different matters relating to this. So you're welcome to check that out, or I can provide the link to that information. And then just to make sure I didn't miss the last part of that question, I assume the last part of it was I assume that $5,500 per year is the limit of contribution. Depends on the type of IRA that you have. So actually for the year 2019, they've upped it to $6,000. So if you have a traditional IRA, your annual contribution limit is $6,000. If you have a Roth, it's $6,000 unless you exceed the modified adjusted gross income thresholds, at which point your contributions can be limited or you may no longer be able to contribute. So definitely check the IRS website if you're interested in contributing to a Roth. SEP IRAs allow you as a business owner to contribute a percentage of your compensation from the business. It's calculated as 25% up to $56,000 per year. And then there are also similar limits for 401ks if you're a business owner and you want to use a solo 401k account that include a company match as well. So it's just important to just do your research and make sure you understand what your contribution limits are. Let's see here. Okay, we have one last question. Can one purchase a primary residence with a self-directed IRA? Unfortunately, not is the short answer. So if you purchase a property and you plan on living in it, as long as your IRA owns it, you cannot live in it. That is one of the restrictions that I didn't quite have time to get into today, but living in the property, renting it to anyone who's disqualified, or performing any sort of sweat equity on the property is not permitted by the IRS. So if sometimes what we've seen people do if they're looking to retire maybe in a particular home in the future, they might purchase it with their IRA and then they might distribute that property back to themselves personally, which later in life they would do that, which is essentially it's like taking a withdrawal of your IRA, but instead of taking cash, you're taking an actual ownership of property. So that would, if you have a traditional IRA, it would be a taxable event, but you'd be able to then own and live in the property that you've held in your IRA. So generally speaking, you're not able to live in it as long as you own it with an IRA. Okay, last question. Bob, can you share one or two podcasts? This might be someone that knows you. I don't know. I don't know if are you doing podcasts on a regular basis, Bob?
Oh, podcasts. I actually, I haven't done any in a while, but if you go into Bigger Pockets, I believe I'm podcast number 211. It's a couple of years old where I was interviewed and talked about my note business and my Memphis rentals, and apparently everybody really enjoyed it. I guess I did a good job, but yeah, go to Bigger Pockets and look up podcast number 211, and that's from me. Great.
Since we're speaking about podcasts, sorry, I have to plug. I'm actually going to be on a podcast this Thursday. It's called Target Market Insights with John Kasman, and he's a real estate investor. So for anyone who's just generally interested in real estate, we're going to be talking about this in a little bit more detail. So just wanted to throw that out there, Target Market Insights. But it looks like that concludes our list of questions, Bob, for the evening. Do you have any final comments or anything that you'd like to make?
Yeah, I do. One other thing is there is a conference in Las Vegas in April called the Paper Source Symposium, and I've attended it the past 5 years. I'm planning to attend this year along with my partner, Josh Andrews. If you just Google up Paper Source Symposium, it's very well done. It's good for beginners. If you want to learn to network, I would strongly recommend it. Bill Mancaro and his wife have been putting it on for 30 years. They know their stuff, and it's no sales pitches, just good education. So I highly recommend it.
Great. Thank you for sharing that. All right. I think that concludes our session tonight. Thanks, everyone, for holding out for the full hour. Hopefully, we were able to give you some valuable information and things to think about. It doesn't end here, so if you think of other questions or you want to continue the conversation, please feel free to reach out. You should also receive a short survey at the end of this asking you for feedback. And please don't be shy. We're always open to constructive criticism or any ideas that you have. So thanks again for joining us. We hope you have a wonderful rest of your day and evening, and we hope to talk to you again. Take care.
Thank you there, too. Take care.